I've always been willing to make a trade-off around that of, being really clear with no ego. I can bring my ignorance as a superpower to go jump and get something. I took a 1-hour conversation to kind of say, hey, here's the offer, and does it seem crazy? I look back at it, it's probably one of the worst deals ever done.
Welcome back to The Turn. I'm Corey Mitchell of Iconic Founders. The Turn is where blue-collar founders talk about the businesses they've built, the value they've created, and what comes next after they sell. Think about this storyline. Bryan Carruthers started his first company in the middle of the 2008 financial crisis, right after college. Tiny little consulting firm. He sells it to a publicly traded business. Then he goes the private equity route. He gets some backing. He buys a small little 15-person shop. He takes it to a national $50 million EBITDA business. Then he sells it to one of the largest companies in the world.
I was at a career fair spring of my senior year, kind of looking in the pamphlet for what companies were there, and I stopped in front of a booth, and the person at that booth said, "Hey, what are you looking for?" And I said, "I'm looking, for this or that company." And she said, "Well, why didn't you come over and talk to us?" So I did. That firm was a small owner's representative consulting firm in Boulder. I chatted with them. I had no idea what owner's representation was. It sounded like, something where I could leverage the schooling I had in engineering, and then maybe the experiences I had interning with a general contractor, and, also seemed a little bit more creative, maybe like architecture, but it wasn't doing any of those things. So went through the interview process with them and ultimately decided that I would join them out of school. When I look back, stopping and pausing there at that moment as a senior in college might have been the most foundational thing for the rest of my professional career, because I've spent most of the rest of my professional career doing owner's rep.
Isn't that crazy?
Firms.
Literally, if you're too hungover to go to that career fair.
Exactly.
Exactly. You don't go there. Yeah,
exactly.
Who knows what job you take? But my guess is, just looking at how your career has progressed, that the entrepreneurial gene was there, regardless of where you ended up. It may not have been owner's rep. It may have been something completely different.
Yep.
But there was some kernel in you that, wanted to start a business because you did it from a young age.
There is. So I went and joined that firm, and actually within the first year, I was more interested in how they were running the business than how I could get better at running the projects that they'd hired me to do. And I think that's where it became pretty clear, I'm going to go do something on my own at some point.
18 months into his first job, he quit. His wife had a steady paycheck. He knew he could eat. Maybe not well, but they could get by. So he decided to take a risk. He started a small business, and then he did something most wouldn't do. He knew he didn't have all the answers, so he called his old boss, and he offered him half the company. They were off to the races. Sometimes surrounding yourself with the right people is worth giving up some of the equity.
So in consulting, because what we were doing was owner's rep consulting, I pretty early on, when I got interested in how the business worked that I joined out of school, realized that consulting is really all about hiring people and paying them, X per hour, or the X per hour equivalent of a salary, and then billing them out to clients at some multiplier or markup of what you're paying that person. That's pretty much it. I mean, that's the business.
Sounds easy.
Yeah. And so, what led to thinking I could do it was realizing, I could charge half as much as I'm being billed to these clients, through another company, and I would make twice as much. I mean, that simple, that basic math. Now, I think it's a lot harder to actually go do that and figure all of that out, but that was kind of the premise, right? I'm just going to do good work and I'll charge less, and I'll figure it out. That's kind of what we built Consilium Partners, the first business on, was that mindset of, we're going to be out there. We were all a little bit younger. We were all willing to maybe, not have as much optimized in the business in terms of the rates we could be charging, et cetera, because we were hungry and we wanted to grow, and we were willing to use price as a little bit of that early advantage. And I think I learned early on through that experience with Consilium that it's important to have people who in partnerships within your business who know more than you, hopefully have experiences that are greater than you. And I benefited from that, not actually knowing what I was doing in, having both John and then we brought in a third partner, Adam, join us as well. They both had unique knowledge and skill sets that I didn't have. And so as a combination, we were greater than the sum of our parts.
So bring in smart people, surround yourself with smart people. Yeah,
I think I realized there's a lot more to that as well. That can be done more thoughtfully. There are other structures, other ways you can do that, that I was able to learn from. But I wouldn't have done it differently either, because I think what we were able to accomplish was a direct result of kind of the three of us ultimately ending up in it, in equal thirds, trying to accomplish what we were trying to accomplish.
Yeah, some people might look at that and say, well, you had the courage to go out and do it on your own. You're the founder. It doesn't seem fair that you only get a third of the business and these other guys that didn't quite take the risk. It was already started. Now, granted, there wasn't a lot to it when you first started, with John. Did you ever have resentment about giving away 2/3 of the business?
I didn't. Again, I think I learned from it and I realized I probably didn't need to. But the reality is there is no business without those guys, their knowledge, their networks, their skill sets as well. And so there's kind of this theme throughout my career of doing stuff pretty young, pretty early on before I actually know what I'm doing. And I've kind of always been willing to maybe make a trade-off around that of, being really clear with no ego. I don't know the rest of this stuff. My superpower, what I can bring to it is maybe you say, the guts or the willingness, maybe it's ignorance, whatever it is. Maybe I can bring my ignorance as a superpower to go jump and get something, going, but then I'm going to bring in the pieces that are needed for it to be successful. And that's
so the
never
partnership,
failed.
The partnership, the expertise you got from them in your mind was worth giving away a piece of the future upside.
That's right.
I live in Colorado, super dry here. And for years, I put an electrolyte in my water. It just makes me want to drink it more. I tell all the businesses I work with, keep your guys hydrated. We talk about hydration as one of the number one points of safety. I've been using Salt of the Earth. This stuff's great. It's got great flavor. You can just throw them in your bag, and wherever you go, just throw it in the water bottle. It'll keep you hydrated, and they taste great. The grapefruit's my favorite flavor. They also have this 4-pack that's pretty sweet. You can try them all. And now they've introduced the creatine, which is also awesome because it's one of these things everyone's talking about now. You got to get your creatine in every day. So try Salt of the Earth. For all the listeners of The Turn, you can get a 15% discount. Just use code ICONIC or click the link in the show notes.
So we were kind of at that point when we got approached by a publicly traded company. We knew somebody who was working over there at a legacy firm that was then acquired by another company, and then they were in the process of IPOing. They had reached out to us to see if we were interested in being acquired, and that timing felt right.
So you get approached, you figure out the terms. I'm assuming you're a relatively small business at the time, right? Yeah. You said at one point you were over 10 people. You started it at what, 24? You're probably late 20s by now?
Yeah, 27 or so.
27 years old.
About 4 years.
It's probably, I'm just making assumptions. I'm assuming it's not life-changing money where you're going to go sail away and off into the sunset with that deal, because it's a relatively small business.
It's not, and even further than that, not only was the value of the firm a couple $1 million is all split 3 ways, right? Certainly not sail away type of money. We actually decided that half of the value would be taken in equity in the company that was buying us. A lot of risks to that.
Yeah.
We saw it as a lot of opportunity. Hey, this company just IPO'd. It seemed like they're going to grow. We still think we're going to contribute a lot to that growth and that value creation. That's great. We would love equity in that go forward company. We'll take a little bit out, but we're really going to put our chips, still on the table in growing it with the firm that acquired us. Again, kind of this theme of better to be lucky than good. I think that worked out really well for us. We joined them when their stock, they were actually trading with units. So what we got was both a share of stock as well as a warrant to acquire another share of stock, because that's how they got public. Those units, I think, were about $6.70 a unit. They grew to the point where they exercised the warrants. We were able to flip around and get more equity based on those warrants at somewhere around the $9-10 range per share of stock. They, within about 2-3 years, were trading up over $20 a share. That company, which has since merged with somebody else, but they were regularly north of $100 a share of stock. So it turned out not to be the wrong move. It turned out to be a good move. Also, I think it's important to point out, we didn't have a broker. We didn't shop the business. This was kind of inbound and, hey, it sounds good. And we had no idea what we were doing related to M&A. None of us had ever done it. I think I took a 1-hour conversation with 1 or 2 investment bankers in town to kind of say, hey, here's the offer. And, does it seem crazy? I look back at it, it's probably one of the worst deals ever done, but for the fact that we got stock and the stock did really well. Things like we didn't get covered appropriately for working capital. I think the multiple that was actually paid on trailing 12-month EBITDA with what our growth trajectory wasn't a good value or a good deal. All kinds of things that I know better now. But again, I kind of didn't care because it was a learning opportunity. It's like, I can go read this in a book. This isn't going to, no matter, even if this is the best deal ever done, I'm not done. I'm not retiring. This is a chance to learn something. I think there's value in doing it. So that's how that got structured. It turns out joining that firm didn't solve some of the stuff that John Adam and I still needed to solve, right? There still needed to be one of us more running the group. There still needed to be an org chart. We still needed to figure out how we were going to continue growing. So I don't think it did what we thought it was going to do. We still ended up needing to sort that stuff out. And I think we did somewhat.
Bryan stayed with the business for 3 years. He learned M&A from the inside. He worked closely with the CEO, and he learned what leadership looked like. Then he left, and he started a few small companies. First one flopped. The second one still gives him some mailbox money. Then he started getting phone calls from private equity. They wanted to learn about his industry. One of those phone calls, it turned into something big.
So again, sort of sounds like this was all intentional. What actually happened was I got a phone call. Actually got a couple of different phone calls and being reached out to through LinkedIn to kind of share with either private equity investors or venture capital more about this, architecture, engineering, consulting industry. Because I think a lot of investors had seen what the firm that acquired us had done when they went public, had seen what the stock had done, had seen how they were doing M&A successfully. And around that time, there became a lot more interest in potentially doing similar things from other investors. And so, I took a couple of those calls, just hour-long calls of what are the industry dynamics, what are typical KPIs, how do you create value around this? I think everybody had the same question. Well, how do you make sure that employees come back, right? The whole company is people. Your assets literally walk out the door every day. You hope they come back. What's the risk around that? Those kind of chats. As part of one of those, I really kind of resonated with the guy I was talking with. He asked me at the end of it, hey, what are you up to? What are you doing? That guy was with a small private equity group in New York. They were called an independent sponsor. For your listeners who don't know what that means, it means they didn't have a fixed fund of capital to invest. They really had ideas that they wanted to go invest behind, and then they raised capital individually to support those investments as they went. I kind of kept chatting with them after that initial conversation about owner's rep and an opportunity to grow an owner's rep firm and do something like what I had done with Consilium, something like what I had learned about from the firm that acquired us, but kind of combining some of those things to say, hey, there are a lot of firms like what Consilium was in the country. They could really benefit from being together in a bigger firm. I think I understand what makes those firms tick and what makes it unique to do owner's rep consulting versus maybe other types of consulting. Let's go build a platform. Let's go build a company doing just that. And they were early enough in what they were doing and crazy enough to take a risk with me that, I presented them really with that business plan and that thesis. And they said, yeah, come try and get that going with us. So
okay, so yeah, this is going to be foreign to most people. So essentially, you got an idea.
Yep.
You go to some people that know how to get some money.
Yep.
How do you structure a deal like that? So essentially, it sounds like you're the founder, but how do you structure the deal, and then how much of the business are you able to hang on to when you're raising the money from someone else?
Yeah, great question. So I really put together the business plan, and they said, yeah, we'll back that. I then just worked with them as a consultant for basically no money, a little bit of money. For the first 6 months working with them, what we called me was being an operating partner with them, and went out and had conversations with smaller consulting firms about what the vision was and saying that we wanted to go acquire them. We had an understanding, me and the private equity investors, that once we got something going through acquisition, I would step in as the CEO to run that firm. So the first 6 months, we're having a lot of conversations. I co-invested with the private equity firm on making those first acquisitions. And then we had an understanding that I would also have what were called profits interests, but really think of them as stock options, where I would get some additional ownership in the firm based on those stock options as we grew and tied to growth milestones. So what did that translate to in percentages? Only probably around, somewhere between 5 to 10%.
Got it.
Now, I've wondered about this a bunch. Why did I do that versus just going and starting something? I think the reason for me was I'd already started something from scratch and grown it to a certain level. I knew what that took. I knew the amount of time that took. I kind of wanted to do the next thing, which to me was growing it bigger, growing it faster. And I felt like if we could do that really successfully, it actually might be better financially, even owning 5 to 10%, than it would have been growing something, as a 100% owner or as 25 or 30% or 50% owner from scratch. So,
yeah. So, I mean, again, like there's sort of a theme here. You're willing to give up some equity to be around, smarter people.
That's right.
That have some capital and take some risk for you off the table.
That's
your
right.
First deal, your wife had a job. So you were going to be able to eat, maybe not eat well. Maybe it's not the Capitol Grill, but you're going to be able to eat. And then you bring in partners that are smart and, you felt like you could learn from.
That's right.
So walk us through that journey now. So you start buying businesses. How does it go?
We acquired 2 small firms in July of 2018. I stepped into the CEO role. We had lined up another acquisition at the end of July, kind of 30-person firm in Boston. We had lined up already another one in Orlando that was doing stuff nationally, around a 90-person firm that we closed on middle of September. And so by the end of that first year, we had brought together 4 firms. We were around 150 employees, and we were really starting to do work in bringing them together. We rebranded as one firm called Answer Advisory. We started building out back office, and we were kind of off and running, I would say, by the end of that first year as, okay, now we've got a real company of a little bit of scale, and we're ready to further build on that.
So as you're going, do you ever start buying bigger businesses as you go?
We do, yeah. So fast forward to the following spring, we bought a firm that was nearly the same size as us, actually.
Oh,
so
wow. So you double the business overnight.
Doubled it within kind of 5 months. I think we closed on that late April, early May. And then continued on with some slightly larger, but still not at our size, acquisitions. You also have to remember that then COVID hit. So right in the middle of all of this, the whole COVID thing. So that was pretty interesting because we had a lot of success growing, and not only doing M&A, but we were growing organically, right? That's important for any business. M&A is an accelerant to growth potentially. It can't take the place of growing organically. So we were growing organically through that entire time. COVID hit. We could do a whole nother podcast just on being a leader during COVID, especially a leader with little experience like I had, and all of those things. Bottom line is, we were lucky. We were really in a deemed essential business in essential industries. We did quite well through COVID, and we got to end of 2020, and in talking with our private equity investors, kind of all agreed, hey, it might be time to look for new lead investors. And that's because the private equity group we were working with had an engineering consulting firm, had just started an environmental consulting firm. I think we're trying to raise capital for a lot of different things. We are kind of getting to a size where they couldn't probably sustain all of the different things that they were invested behind. And I think we also were ready for kind of the next tier of partner that could continue to accelerate our growth. So we went through a process, just like processes any selling owners would go through in terms of marketing the business and looking for the right fit, but came out of that process with Sterling Investment Partners as the private equity firm we saw the best fit with, in terms of continuing to be aligned with what our employees and management team saw as the growth opportunity. And when it's called recapitalizing. So we did sell the company, but really it took out our prior private equity investor entirely. Management and employees rolled equity forward alongside, but also got to take a little bit money out at that juncture. And then Sterling came in with the majority of the equity. We were right around 350 employees, I think, at that time.
They recapped the business with $1 billion fund. Now they had more firepower to keep doing bigger deals. And he just kept growing it. It got bigger and bigger, and all of a sudden he's $50 million in EBITDA. Then a global consulting firm came calling. This time, he was equipped to do the right deal. He had the best advisors in the world around the table with him. Now you're really kind of speeding, right? I assume you're buying even bigger deals. Where do you go from here, and take us up through your transaction with Sterling?
So really it was continuing to execute the same strategy by and large. I think what we did differently is we got even more strategic about who we were buying. What is the new industry it's going to get us into? What are the geographies that are really additive? Where are we really adding value? So the kind of two transformative things we did another 7 acquisitions with them. 2 of them were much larger. One got us into the federal sector, intelligence agency communities, and an area that we thought was really sticky and meaning, strong client relationships, kind of market leading position. The other was to really expand our presence in utilities, electric transmission distribution on the East Coast. We did that because we knew there was a lot of demand coming around data centers, around electric grid resiliency, et cetera, growing markets. We didn't have as much of a presence in it. The culmination of all of that, as well as continuing to scale our management team and adding some other really important pieces to continue to be running the business well, was we got about 2.5 years in. Now we're around 50 million of EBITDA, a little bit over. Now we're around 1,200 employees, right? So rapid growth. This is all under 5 years since getting it started with
it's crazy.
First private equity group. And what happened was we were running a really good business. We actually thought we were going to continue partnering with Sterling for probably another year at least, because they had capacity to continue supporting us in it. But we attracted some inbound interest from a very large, publicly traded, global leading consulting firm. They felt what we were doing was really appealing, was relatively net new area for them. And because we were running a good business and we knew what would be a good fit for us, we were able to engage in conversations with them that made it clear that this could be really additive for everybody if we decided to join them and sell to them.
So did you get advice this time? Do you have now some kind of banker,
right.
lawyer?
So we have the best, right? All the best advisors. And we also have sitting there with us, right? Sterling and a private equity group that this is what they do, right? They've been part of helping firms, grow from kind of that undergraduate level to graduate level understanding and size and sophistication. And they know all the things to think about. They were incredible partners. And so, very different process than that first one, selling Consilium, just in terms of all of the support and the structure of how things got done. And it turned out to be a very successful deal for all of our investors. It was a very successful deal for all of our employees. And I think it's really cool to point out some of those original selling owners that, sold their business, including the first one of those first two 15 person owner business, one of those selling owners was still in the company 5 years later, had taken money off the table in the first transaction, had taken money off the table when we capitalized to RTC and Sterling, and then took money off the table when we sold from Sterling to this publicly traded firm. And if you look at the value that he got out of that, it is significantly more than he would have gotten continuing to grow his business successfully for 5 years if he'd stayed on his own.
So sometimes these private equity things can actually go pretty well with the right leadership.
They can go really well when there's alignment, right? And I think that's what's always key. When there's alignment around what it is that you're trying to accomplish. When you get that right, it's like pouring gasoline on a fire.
What's changed in your life, since you did the deal?
What's changed is that I have this whole perspective of kind of the first chapter of my life was getting to this point. And because of the wealth and the resources I have now, I'm in a very fortunate position of really trying to be intentional about what is the next chapter? What do I want it to be? Maybe it's not driven by all the same things and needing to get to a certain place because I have more flexibility. What I'm really landing on is this. I want to work with people that I really enjoy being around. I want to have a lot of continued experiences with my family. I mean, I think that's the biggest thing that wealth can do, right? Is it opens doors for experiences. And I want to be in a position where I can continue to kind of answer or try to come to an answer to that question. What does the CEO do anyway? But, come up with ways that I can kind of pass that along. The ways mentors and people I respect like you have done at various points along the way for me.
Yeah. I mean, you're probably going to get a lot of phone calls from this show. I'd like to have a guy like that can start a 15-person business and get to 50 million in profit before he transacts. I mean, that is a nutty thing to think about in five years.
Yeah.
Congratulations on doing that. Well, listen, Bryan, I cannot wait to see what you do next. You're a young man. You got a lot of runway ahead of you. And thank you so much for sharing this amazing journey. I can't wait to catch up next time as a follow-up when you're telling us about your next success.
Well, I have to say thank you to you, Corey. I think what you're doing on this podcast, and I know some of the other things you're doing in the industry, it's exciting to see. I think this is a great way for all of us to continue to come together to raise the tide. So thank you for that. And thank you so much for having me on today.
3 exits, each one bigger than the last. And he never owned more than a third of any of them. Most founders are obsessed with ownership percentage. Bryan, he was obsessed with acceleration. You can own 100% of something small, or you can own a small piece of something that can move much faster than you could on your own. Bryan figured out which game he wanted to play. I'm Corey Mitchell. Thanks for watching The Turn. If you haven't yet, check out my interview with Chris Myers. He bought a byproducts company and turned it into a $72 million business. What a story. For more information, visit us at iconicfounders.com or email us at theturn@iconicfounders.com. Let's win.